Welcome back to another stock analysis, where I look at some key metrics to calculate the fair value and my buy price for the stock. Today I'm going to analyze one of the biggest franchises in the world, which of course is McDonald's. Last, they generated a revenue of $23.2 billion, they have a market capitalization of $186 billion, and they are a restaurant company. 42% of the revenue is made from company-owned stores, and 56% is made from franchises. The company generates revenue from the franchises by license fees, royalties, and rents. The last 2% comes from the other category. If you want to know more about the revenue, you can check out the annual report of McDonald's, which I have linked down below. The revenue can also be divided geographically. But McDonald's don't provide much information about the graphically distinction. Only that 42% of the revenue comes from the US and 58% from the international markets. Enough about the introduction. Let's find out if McDonald's is a good stock to buy at its current value. The key matrix I use to calculate the fair value and my buy price for McDonald's is the dividend yield. I'll start with plotting the dividend yield for the last few years in a historical chart. I choose the dividend yield because a consistent dividend politic, for me, is the best indicator for a stable company. Additionally, a steady dividend payout helps to stabilize my portfolio, and it makes it easier to rebalance my positions. To create some sort of signal line, I take the 5 years moving average of the dividend yield and plot it in the chart. The simple approach is now that the stock seems overvalued when it's under the moving average and undervalued when it's over it. The average of the last 5 years is 2.42%, and I would like to define this as the historical dividend yield. Since the historical yield is the fundament for my fair value and buy price calculation, this value shouldn't be too volatile. In an ideal case, the curve will give a straight line. I can measure how much the curve deviates from the ideal straight line by calculating the relative standard deviation, which for McDonald's is 8.2%. To the historical yield, add a personal defined marginal safety of 25%. This marginal safety will be adjusted upwards or downwards depending on the matrix of the company. My first criteria is the stability of the dividend measured with the relative standard deviation. With this value, I can measure how volatile the dividend yield is. A high relative standard deviation will higher my risk to invest at a bad timing. As said earlier, the relative standard deviation for McDonald's is 8.2%. This value is inside the yellow section of my rating scale, therefore the marginal safety doesn't change. As a dividend investor, the dividend growth of course is a very important matrix for me. In 2007, $1.50 were paid, and in 2022, $5.56 is expected. McDonald's has paid and increased the dividend for 46 consecutive years, which makes them a dividend aristocrat. In the last 5 years, the average dividend growth was 7.7%, and that's just inside the light green section of my rating scale. Therefore, I'll subtract 5% from the marginal safety for the dividend growth. By looking at the payout ratio, I'll find out if this dividend growth is sustainable for the company. I always look at the payout ratio in respect to the free cash flow, which is the cash flow the company has available after they've paid all necessary expenses. The free cash flow for McDonald's has increased rapidly, from $4.2 billion in 2018 to $7.1 billion in 2021. The cash dividend were respectively $3.3 billion and $3.9 billion. The average payout ratio is therefore 73%. This value is inside the yellow section of a rating scale. Therefore, the marginal safety doesn't change. Next, I'll take a look at the debt situation. The company has a debt of $30.9 billion and have $4.71 billion in cash. When the cash gets subtracted from the debt, and this value then gets divided by the EBITDA, the debt to equity ratio is found. The EBITDA is currently at $12.18 billion. This leads to a debt to equity ratio of 215%. This means it will take the company around 2 years to pay off the debt if the whole EBITDA were used for debt settlement. For this value, the marginal safety doesn't change. The last thing I'm looking at is the growth of the company. The revenue has increased from $22.8 billion in 2017 to $23.2 billion in 2021. This gives an average growth of 0.44%. In the same period of time, the EBIT increased from $8.8 billion to $10.1 billion, which gives an average growth of 3.4%. The margin is found by dividing the EBIT with the revenue, which in 2017 gives 38.6% and in 2021 increased to 33.4%. Since the EBIT increases at a higher rate than the revenue, it only makes sense that the profitability of the company increases. In this case, it increases with 2.94% in average. An EBIT growth of 3.4% is in the yellow section of a weighting scale, which gives no further adjustment. An increasing margin, on the other hand, is a good sign, and for an average increasement of around 2.94%, I'll subtract 5% from the marginal safety. Since every matrix from analysis has now been collected, it is time to adjust the marginal safety. Minus 5% for the dividend growth and minus 5% for the margin growth. The new marginal safety is therefore 15%. This leads to a desired dividend yield of 2.78%. By a current dividend of $5.56, I should therefore don't pay more than $200 for the stock. By ignoring the marginal safety, the fair price of the stock is determined, which for McDonald's is $230. These values can also be shown graphically in the chart for the historical dividend yield. This is done by adding the marginal safety to the historical yield curve. This then gives a new curve which always lies 15% over the historical yield curve. As seen in the graph, the historical yield line and the marginal safety line are over the yield curve. Therefore, I consider the stock as overvalued. Finally, I consider the stock at its fair value when the price is $230. I will buy the stock at $200 and the stock price is currently at $251. If you did like the stock analysis, please give the video a like, let me know in the comments which stock you would like to see next, and subscribe to my channel for weekly content.